Hey everyone, thanks for watching. I have a show that many of you have been asking for. You've been asking to get a CPA on the horn, and most specifically, let's talk depreciation. So we are welcoming back a guest from about 6 months ago where we talked about 1031 exchanges and all other kinds of things real estate. Let's welcome Bob Langworthy to the show. How you doing, Bob?
I'm doing well, Michael. Thanks for having me back on again.
Oh, you got it. Your shows are still one of my most popular. So CPAs are sexy, I guess. I guess that's what it is.
Yes.
Well, at least with real estate investors, they are. So, as
That's
you
right.
know, I reached out about depreciation. You said enthusiastically thumbs up because you know it's a topic that people should think about, they should understand, and there are a lot of decisions to be made. So, um, why don't you first introduce yourself for those who haven't seen the past shows, and then we'll get into
Sure.
some base questions.
That sounds good. Yeah, my name is Bob Langworthy. I'm an accountant on the other coast. I live and invest in the state of Maine, and I run an accounting practice here. We're getting geared up, the six of us, for a busy tax season, and looking forward to that while also renovating a duplex that we closed on December 31st.
Oh, congrats!
One of our goals for 2019 was to close on another property, and December 31st we signed the paperwork, so
Hey,
we
it
could hit
counts.
that goal.
You got it
Yeah.
done. Congratulations.
Yeah.
So let's talk about depreciation. Why don't you first, as simply as you can, define what it is, and then we'll walk this road together.
Sure. Yep. So depreciation is what the IRS allows an investor to do to reduce the the value of the property. They take your purchase price, and if it's residential, you divide it by 27 and a half years, and you take a little chunk of that every year as an expense.
Mm-hmm.
And it's a non-cash expense in that you don't have to spend any money to have this expense show up on your income statement.
Mm-hmm.
Depreciation, there are various lengths of time depreciation can exist. It can be 5 years for something like appliances, 7 years if you're into commercial property. 15 years is for land improvements, so that would be things like driveways and sidewalks and landscaping. 27 and a half years is for residential property, and that's any size residential property. So we sometimes get the question with when it comes to borrowing money, hey, the bank has me getting a commercial loan for this 6 unit. Does that mean I have to take 39 years of depreciation? And the answer is no. It doesn't matter what the loan is called. It matters how the building is used. So as long as it's at least 80% residential, so if you think of a mixed use property, as long as it's 80% residential,
Oh,
you get the 27 and a half year depreciation treatment, and then commercial is 39 years.
very cool. And folks, just to tie this together with the shows earlier that kind of sparked this discussion is something that Bob just brought up is a non-cash expense. That's the magic word, the magic phrase we all need to get used to, because if you watch this channel, you hear me talk about net cash flow, and then there is net income. And those numbers can be very different. And it's often because of how depreciation is levered by that investor. So that's the riddle we're going to walk together today. Does that make sense, Bob?
Absolutely. It's all about cash flow. That's the money you get in your pocket. That's what matters. And we want to do what we can to reduce the net income while keeping that net cash flow up.
Yeah, I like cash. That's how I pay my bills. And I'm willing to pay the IRS whatever I legally owe, but not a penny more. And depreciation is one of those things they give me as a real estate investor. So I like it.
That's right.
Well, you have some examples. You've given us some terms. Um, how do you want to kind of walk this together? Do you want to just talk, like, give a rough example of how
Sure.
net income and net cash can be different because of depreciation?
Yep, let's do that. Let me walk through just a rough example here. And what I did is I sketched out a $750,000 property. It's a 10-unit residential in this example. And I valued the land at $100,000, and land cannot be depreciated. So we're only depreciating the $650,000
Yep.
on this property over 27 and a half years because it is residential
Yep.
property.
Mm-hmm.
With cash flow versus net income, the concept of leverage comes into play.
Yep.
How much money did we put down when we bought this thing? How big is our debt service?
Yep.
Because our entire monthly payment is impacting our cash flow.
Correct.
But it's only the interest and depreciation that's impacting our net income for tax purposes.
Exactly.
So it's almost like you need to have two different financial statements in mind. One is your income statement that's taxable, and the other is cash flow that's in your pocket.
Yep.
So I ran it with three different scenarios. One with a 20% down payment. I made some assumptions about insurance and property taxes, but all utilities are paid by the tenants in this example.
Yeah. Bob, one quick question. I just want to make sure I have the numbers right. So bought it for $750. You valued the land at $100. Land is not depreciable, so you subtract that your basis becomes $650, correct?
That's correct.
Then you take $650, again, simply talking, and you're going to divide that by 27 and a half, right?
That's correct.
All right, let's just put a number out here so people can follow along. I get on my fancy calculator roughly $23,500 in depreciation. Is that what shows up?
Yep.
All right, so that's the number I play with. I'm like, okay, so 23, I would round it in my silly head to $2,000 a month because I think monthly.
Yeah, good.
Right? So I'm like, okay, so I have $2,000 a month in this phantom non-cash expense. I'm thinking about this all the time when I'm buying stuff. So that's where we're at. So go ahead, back to your examples.
Yep. So now if we assume a 20% down payment.
Yep.
And now we're going to borrow. So we're going to borrow 600,000. 20% of the 750 is 150. We're borrowing 600, and I just put in 20 years and 4.5%.
Sure.
And that produces a monthly payment of $3,800 per month.
Yep.
So on our cash flow side, and I came up with a rent number that may be low, but I kept it consistent, $900 per month per unit.
Okay.
So we've got $108,000 in rent.
Yep. So again, tie this together monthly rate. So you got $9,000 in month of rent, right?
Yes. Okay, great. Let's do it that way. That's easy to do.
It's smaller numbers, right?
Yep.
So we got 9,000 in rent. I think you said 3,800 in mortgage expense.
Yep.
Right. We could put off to the side $2,000 in depreciation. Right. I'm just playing with all these numbers, but go ahead.
That's right. Yep. And then I just put in insurance at it's $833 a month. That's $10,000 for the year.
Makes sense.
And then property taxes, I put in at $25,000, so that's right around $2,100 per year.
Yep.
So on the net income side, what does that look like then in terms of my tax liability? I've got annual income of $23,000. My monthly income that's taxable is around $1,900 in this scenario.
Okay.
On the cash flow side of things, I have $2,287, so roughly $2,300 in monthly cash flow. So I'm coming out to the good by about $400. So every month I bring in $2,300 into my bank account. It grows by $2,300.
Yep.
But I'm only paying taxes on $1,900 of that.
Exactly.
And
that's the math I want people to hear.
Exactly.
Depreciation hid $400 a month from the IRS in this example.
Yep.
Hid is the wrong word. It's
their idea.
Yeah, it's their. Yeah, you are leveraging the rules that they put out there.
That's right. Yeah. And then if you look at that same scenario, and now it's 50% down payment, right? This person isn't as concerned about leverage, maybe as a typical investor.
Okay.
All other numbers being the same, just changing that monthly payment on the cash flow side and the interest you can write off on the tax side.
Yep.
Now your taxable income every month is $2,700, but your cash flow every month is $3,700. Now you're saving $1,000 per month from being taxed due to the depreciation. So very powerful.
Very powerful stuff. And again, this is not cheating. This is not illegal. This is in the IRS codes. It's been used for decades. It's one of the ways that the rich stay rich, frankly. And that's why there's a big difference between what I call net, 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 right? Versus what you pay
Yep,
the IRS. And it's because of depreciation. So I
that's
love
right.
that.
Yeah.
Love that example. Did you do one all cash?
Yeah. So when you get to all cash, then, your subscribers are going to have different viewpoints on whether to use leverage as much as possible or to buy with all cash. Most of the big real estate investors use leverage heavily.
Oh, absolutely.
But
Yeah.
for that person who wants to use all cash, 100% down payment, then the amount that you're essentially saving from being taxed is exactly equal to your depreciation,
Yep.
because there's no debt service on the cash flow side.
Mm-hmm.
All the expenses are the same for cash flow and the income statement, with the exception of depreciation. So in our example here,
Yeah.
$23,600 now on this $750,000 property is shielded from being taxed.
Right.
So very, very powerful. For those investors, maybe they're towards the end of their investing career and their
Mhm.
properties are paid off,
Yep.
or maybe it was a deliberate strategy. There's a significant savings from depreciation.
Yeah. And again, just to put it in the math of how I think, right, monthly, right? Just assume you, for whatever reason, you're in a situation where you wrote a check, you didn't get a loan. You have a building producing 9,000 a month. You're going to basically get 2.5 units of that rent, assuming no expenses, which is ludicrous, but go with me. You're going to get roughly $2,000 of that 9,000 tax free
That's great.
because of
Yep,
depreciation,
exactly.
right? So
Yeah.
that's a pretty cool thing. So that's just the basics of what depreciation is. It's the
That's right.
rough outline. That's like first grade,
That's right. Yep.
right? Because there's
Yep.
so much more for
Yeah.
depreciation, right? We have cost segregation, and I believe just recently bonus depreciation.
Yeah. Let's talk about those individually, and
Yes.
then we can
Where you want
talk
to go?
about them together.
Okay, you're in
So
charge. What first?
let's talk about a cost segregation study. There are other videos on your channel about this, and it's a pretty simple concept. It's typically done on a larger property, maybe one that was purchased for $500,000 or up.
Okay.
And what it does, it's done by a third party, and they come in and they look at all of the systems in the property and divide them into different categories for the purposes of depreciation. So let's say, again, it's this 10-unit residential is bought for $750,000. They come in, and this cost segregation company says, well, of that, there's actually this amount that is 5-year property,
Right.
and some of it is 7-year property. And here's a really interesting piece about cost segregation studies that people don't often think about. We've already said you can't depreciate land.
Yeah.
Well, if you've got a 10-unit apartment building, you've got land. In this case, we've said it's $100,000 worth of land, but it's probably mostly paved and landscaped.
Exactly.
Now you can assign some amount of value to that paving and landscaping. And now, instead of having 100,000 you can't depreciate, well, maybe the land is really worth 50 or 60,000, and the improvements are 40 or 50,000, and you can then depreciate those land improvements because you did a cost segregation study.
Yeah.
It's beautiful. Now you're still left with some 27.5-year property, but that's okay. So now you've got, and I put together an example of this just using some rules of thumb, if you will, for 5-year and 15-year property. So I said with this building, 20% of the depreciable basis, which we had said was $650,000, 20% of that we're going to call 5-year property. And that's going to be, anything that looks like wiring, plumbing, flooring, wall covering. So it's not hard to get up to somewhere around 20%.
Okay.
So 20% of that 650 we were going to depreciate is now in a 5-year category. So that's greatly accelerating.
Yeah. So again, just so people can follow along, right? So 650 grand times your now 20%. So you're taking 130 grand of the original 650. And now instead of 27.5, you're doing it at 5 years. All right.
You got it. And then the remaining 520 of that 650 is still at 27.5 years.
Sure.
But I know what you just did. You just said, well, what's that 130,000?
Yeah, I did.
Divided by 5.
I did. Yes.
Yes, that's $26,000 a year
Yeah.
for 5 years. That is huge, huge.
Again, think in my simple world, that's $2,000 a month. That's how I break
Yes.
that down, right? 200, a little bit
Yep.
more.
Yep. And your 520,000 is that is 18, let's call it $19,000
Okay.
annually. So that, it's around 1,500 a
Well,
month.
you add those together, it's $4,000 instead of $2,000.
That's right.
Oh my
And then in
goodness.
this example, I said, well, what if 30% of the value of that land was land improvements, things like
Okay.
the parking lot
Yeah.
and the landscape. And again, just to kind of keep it conservative. And that's only $2,000 a year, but it's still something.
Right.
Now, instead of having $23,000 per year, 23,600 in depreciation,
Yeah.
if we do this cost segregation study, we have $47,000 per year.
So what I take from this is don't be a lazy landlord.
Right.
Right. In our first example, we were really excited about saving $2,000 legally. Now what you're saying is, again, rules of thumb and get your CPA involved and blah, 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 blah. But now we're up to $4,000.
That's huge. Yeah.
I mean,
Now,
that's
we
double.
have to
Come on, Bob.
say,
That's not huge. That's a double.
yeah, that's right.
Awesome.
Now, it's worth noting that after 5 years, right, because we moved $130,000
You pulled it early.
to a 5-year schedule. After that 5 years, your $4,000 a month in depreciation is going to get cut down to around $1,500
Sure.
per month.
That's fair.
So you've got a 5-year window where you've got tremendous tax savings.
Yeah.
And at that point, then you need to decide, well, do I want to do a 1031 on this into another property? Do I want to keep this and just deal with having less depreciation, or maybe there'll be some other strategies to consider? So yeah, cost segregation is fantastic. It's a great benefit for landlords, whether they're residential or commercial.
Again, just more examples of how the rich play the game legally, and their net in-pocket net cash isn't taxed. We just saved $2,000 a month to $4,000 legally with cost segregation. I can't wait to see what you do with bonus depreciation. Oh my goodness.
Yes. Bonus depreciation has been around for a while, and it has been applied to various asset types. Vehicles, for example, if it's a vehicle that's a work van, work truck, or a large SUV, the 6,000-pound limit that Anna was talking about the other day. Congratulations to Anna's husband on his shiny new vehicle.
There you go.
And 6,000 pounds sounds big, but that's also a Tesla Model X. So for those who are interested in electric vehicles, the Tesla Model X qualifies.
Wow.
It can also be a large vehicle. And for those of your followers that are familiar with Grant Cardone, they may know that Grant bought an airplane.
Yeah.
And he bought an airplane because he had a tax problem.
He did. Yeah.
And the way he described it is, I got a call from my accountant. The accountant said I had a problem. I said, don't call me with problems. Call me with solutions. And the accountant said, well, you need a $50 million expense this year. He said, I'll buy a jet.
There you
and
go.
Grant Cardone went out and bought a jet, and that solved his tax problem. And as long as he uses it more than 50% of the time for business purposes, it qualifies for bonus depreciation. So it's a fantastic opportunity. Now, what Congress did with the Tax Cuts and Jobs Act, there's actually a mistake in the Tax Cuts and Jobs Act. You can look back on the congressional records, and there's been a lot written in kind of nerdy accountant blogs about the mistake that they made. And it has to do with a type of property called qualified improvement property.
Okay.
And that is, to keep it simple, it's improvements you make on the interior of a building.
Okay.
And Congress said, we want that to be 15-year property. And instead, it came through in the drafting process as 39-year property. So there's all this, what are we going to do about this? Well, there are still ways for investors to use the qualified improvement property and take bonus depreciation on it. And where you do it is with your 5-year property. So now you've done a cost segregation study.
Yeah.
And let's suppose you're having a fantastic year and you need to offset a sizable amount of income, and you can do it through real estate because you've talked with your accountant about the passive activity rules and all those things. We'll go back to our example, and if you recall, we said $130,000 of this building was 5-year property.
Yep.
Because it's 5-year property, it's eligible for bonus depreciation.
Wow.
So now you're taking that whole $130,000 of depreciation in 1 year. Now, that's not sustainable. I mean, that's a 1-year thing.
Yeah.
But it's fantastic for that year, particularly if you've got a large capital gain that you want to offset. You've got something else going on in your real estate portfolio. That can be a fantastic strategy.
And the reason I wanted to bring this up, and I'm glad we got here, is I'm very open with my audience, right? I indicated I think multifamily is overpriced, and I sold a couple of apartment buildings. I 1031 one of them via an exchange, but I took the other one, and just because I have the ability, given other purchases, to bonus depreciate and to, legally hide the gain that I show in that apartment building. So
great.
It's all fair and legal. So
well, and just a quick sidebar on that. It's possible for an investor to buy a bad deal because they feel pressure from their 1031 exchange.
Sure.
And it's better sometimes to just pay the tax and have the cash than to feel squeezed by that 45-day time frame that you've got with your 1031. So good job on that.
Yeah, thank you very much. And again, I only think cash in my bank. All this other stuff, tax this and leverage that, and it doesn't mean anything. I pay bills with cash that sits in my account. So that's pretty much how I simplify my life.
I like it.
Yeah. So what else should people think about depreciation, cost? Oh, you wanted to put them together, right? You wanted to put cost segregation.
Yeah, that is cost segregation and bonus depreciation together. So with our example of the $130,000 that, as a result of the cost segregation study, was now 5-year property.
Right. Okay. Instead
of taking that over 5 years with bonus depreciation, they took it all in 1 year. So that can be a great strategy at the right time.
Yeah, it's definitely advanced. Definitely work with your CPA. But again, the reason we're having this conversation is a lot of people have heard some of the videos and how I talk about what my net cash is versus some of my legal tax maneuvers. And Bob you did a great job of simplifying, because I know we could have gone down some significant rat holes. I love what you did here.
Thanks.
Anything else you want to just make sure people know or understand about depreciation?
Sure. There can be a downside to depreciation.
There you go.
And the downside is that the IRS tells you you can take this depreciation and save some money, but when you sell the property, you have to recapture the depreciation. That's their term.
Yep.
And now this is when you sell a property and you're not doing a 1031 exchange, you're just selling it outright.
Yep.
You have to recapture the depreciation, which means you pay tax on it. That's taxed at ordinary income rates.
Yeah.
Capped at 25%, but it's not hard to get to 25%.
Yeah.
So now you've sold a property, and let's use a simple example. Somebody bought a property for 200 and they sold it for 400. So they're thinking they have a $200,000 gain.
Right.
But in the interim, they've depreciated it by $100,000.
Right.
So they actually have a $300,000 gain.
Correct.
Well, on top of that, that $100,000 of gain is $100,000 of it is subject to depreciation and recapture at 25%. The other 200 of their $300,000 gain is long-term capital gains, which are, for most taxpayers is 15%. For some, it's 20%. So now they've got a sizable hit because of depreciation recapture. So that's just something to be aware of for those people who are selling a property outright. And there are perfectly good reasons to do so.
Yeah.
But just know that you may have a higher tax burden than you're anticipating.
Yeah. And again, this is the legal rules that the rich play by. And depreciation recapture, frankly, is 100% logical in my mind, because you've been given this phantom cash expense for the life of your ownership, and the IRS wants it back. I think that's totally fair. And again, it will be taxed at income, ordinary income, versus capital gains, given the caveats for income level and all of that.
Yeah.
But I think it's more than fair that happens. And again, this is the whole, do you 1031 exchange? Do you
Yeah.
pull the ultimate tax maneuver and die and give it
That's
to your
right.
heirs? I mean, there's
Yeah.
all these other choices out there.
Yeah, that's right. Those are the two great ways to avoid capital gains.
Yeah,
Um,
I like
and
1031 a lot more than the other one, but hey,
that's right.
it is
Yeah.
out
Yeah.
there.
And the other issue that people should be aware of and we want to talk with their accountants about is how does their individual state
Yes.
view bonus depreciation in particular? Not all states accept bonus depreciation. So
Ah, I didn't know
you
that.
could make a tax move federally that uses bonus depreciation and saves you money, but still have a state liability,
Okay.
which might not be a bad problem to have.
Yeah.
But it's worth noting. We're just covering the federal side of things here.
Yes. Very, very cool. Well, Bob, how can people find you, follow you, reach out to you, become a client of yours? Could you give us so much great stuff?
Yeah, great. Thank you. We work with clients from around the country. We work with real estate investors and small business owners, and we work with a wide variety of clients. They can contact me via my website, which is mainbeancounters.com,
I
Maine
know.
like the state,
Yeah.
beancounters.com, or I can be found on LinkedIn, Bob Langworthy. I can be found on Instagram, BeanCounterBob. Those would be the three primary ways that they can get a hold of me.
Well, folks, many, many, many of you reach out for tax advice. You ask me to give referrals, and now you know why I always point you to Bob Langworthy, because he's the guy. He works across the country, and he keeps giving us value. So, Bob, I want to thank you very much for doing this, and you have a wonderful day.
Great. Thank you, Michael. You too.
All right, you got it.